All attendees are in listen-only mode.
Well, thank you for all attending our seminar today. We are thrilled to be here to speak with all of you. Pitney Bowes has really been committed to small and medium-sized businesses for over 100 years, from our roots in mailing, helping businesses to communicate with their clients, market their brands, collect on invoices, and now ship their goods and finance their businesses. We're really invested in your success. So thank you for joining us today as we talk about the Liquidity Playbook. We're here to talk to you about some tools to help you optimize your liquidity throughout the market fluctuations. And there couldn't be a better year to talk about this, of how to handle the unexpected. I'm lucky to be here with my brilliant colleague, Shawn Halladay, who boasts over 40 years in financing and specifically equipment financing. He started his career out in public accounting, has authored about 10 to 13 books on equipment financing, and is now, we're lucky enough to have him as our CFO of the Pitney Bowes Bank. So thank you, Shawn, for joining us today.
Thank you, Samantha.
I am here as your navigator through the discussion. I have in business development and strategy at Pitney Bowes and Financial Services. And Shawn and I work together a lot, so at least if we can't provide some knowledge, we'll provide a little bit of entertainment for all along the way.
Indeed.
So what we'll cover today is really about knowing how to manage that cash flow, how do you manage the drivers, and what alternatives you might be able to seek along the way. We encourage you to ask questions throughout or at the end. We'd love for this to be interactive as we go along. So Shawn, tell me, why is it so important that every business have a liquidity playbook at their fingertips? I know I've talked to a lot of business owners who say, I manage everything well enough because I pay it all with cash.
Well, you know, if it just to continue the sports analogy, as a business owner, you have your game plan. You know where you want to be, and the purpose of the playbook is just to allow you to react to specific circumstances and things that occur during your game as you take your business forward. And so to be able to recognize the challenges and adapt a proper response is just critical. And we're doing this in the context of cash, because cash, as you know, is just the lifeblood of every business. Doesn't matter how good your product is. If you don't have enough cash to fund your inventory, you're not going to be successful. So we just, you know, knowing where you are from a liquidity standpoint is critical. And as Sam mentioned, especially in today's environment.
I think of it also, Shawn, even in times of stability, this is so important, because you want to be able to take advantage of those new opportunities that come up and to be able to, you know, continue that ongoing business. So if you have different sources of cash and you know where it is, you really know that you're ready for anything.
Exactly. And you know, as a CFO of the bank, first thing I look at every morning is, where do I stand from a cash point of view? I mean, you think, okay, banks have scads of cash, and that's kind of our business. But I look at my cash liquidity reports and my cash balances every day, first thing in the morning.
Great, that's really good practice to do. So as we talk through this, you said the first thing that is it's sort of a dreaded step, I think, the cash flow statement. It can be a daunting exercise, Shawn. Why is this so important?
Well, let's take it out of the cash flow statement is great. It tells you where you've been and where you have put your cash, what you've invested in, what your operations have done. But it's not dynamic, and so it's a financial reporting requirement, and the breakdown is great, but it does not give you a feel for what's coming down the road. And I think that's critical, that you that you get that kind of a tool in your arsenal as opposed to just the cash flow statement, because you need to know not just how you generate cash, but the timing. Where do you spend your cash? The timing. So a cash flow statement, if it's not daily, at least you should be doing this weekly, where you list out, okay, here's the cash I'm going to get from my cash sales. Here's what I expect to collect on my receivables. Here's what I expect to pay my suppliers. Here's what my payroll nut is. We've all, Samantha's run her own business too. We all know that that payroll time comes around if you can get a knot in your stomach if things aren't just rosy. So you need to be able to identify all of those cash flows, not from a book point of view, but a true cash receive and cash spend. And that will tell you for the next month, for the next week, if you're going to have a shortfall or not. And that's critical. So
what do you say to those business owners who say, I really do this all by gut instinct. I know in my heart how the rhythms of my business.
I see that all the time, and I'm not suggesting you do things that are redundant, but it does not give you the ability to react, because if something changes, your gut's no longer telling you the right thing because the direction has changed. So that's why this is critical, that you have a good handle on what your liquidity, and we use liquidity. It basically means your cash and ability to pay your bills and create profit.
Well, as my father used to say to me, Shawn, in God we trust, all others bring facts. And, I think it helps you with the fact base that, to your point, I think you brought this up, there might be slight changes that are happening in your business that your gut will overlook. And that when you're really doing this on a regular basis, you'll start to see what's happening, and there's slight changes going on. That's right.
And I'm not saying that this is easy. I mean, you'd definitely rather be out on the floor, watching your manufacturing process or on the phone selling. But this whole cash concept of the cash flow cycle is critical, and you need to manage this because if you look at the statistics, the reason for most small businesses failing is lack of cash. And you don't want to be in that when you can take steps to control that.
I saw a recent Intuit survey that said about 69% of small businesses say that cash flow is what keeps them up at night. And when you've got this regular routine going on, that can sort of ease your tension.
Exactly.
As you go through.
Yeah, well, that's a good point. And we talk about the cash cycle, and just to level set here, if you think about the cash cycle, you have $1 in your pocket, and in a typical cash cycle, you're going to buy inventory with that. Then you're going to add value and sell that inventory, and you will have a receivable. So you have cash sitting in the form of inventory, you have cash sitting in the form of receivables, and then when those receivables are paid, that represents profit because that's embedded in your sales price. And so now if you put $1 into the cycle, think of it as a funnel. You pour money into the funnel and you pour $1 in, and it comes out at $1.10 at the end of the cycle, or whatever your margin is. For a grocery store, it's 1%. For a tech company, it's 40%. But if you don't have that cash to push through the cycle, you're not going to be profitable. So velocity and amount are critical there.
So I would say, in good times and bad, what's the biggest aha of this exercise?
Well, I think it's going to be, you'll probably be very surprised at what's eating your cash. I mean, where's your drag? Inventory. Okay, we like to have a good inventory, a good selection for our customers, but if you put $1 in an inventory, until you sell it, it doesn't do you any good. And you might be surprised to see that whereas you pay your payables on a very timely basis, because that's just what you want your suppliers to be happy. You look at your receivables and you tell them, okay, you pay within 30 days or 15, and all of a sudden you find that they're paying in 45 or 60. Those are the ahas of wait a minute, this isn't what I thought. So,
Right.
because you get used to it. You just get used to what's normal. And what we're saying here is let's identify the realities and maybe have to define a new normal or see when it's not as normal as you think.
Right. And there is that sort of cash recovery cycle that can be bad for certain. So you need to understand what's eating up the cash in the meantime.
Exactly. I mean, you need to know that, okay, when that cash first enters the cycle, how long does it take me to flow through the entire cycle and get back to me?
Absolutely.
And so there's all kinds of metrics, and these are not, they're not difficult. They're just simple ratios that can help you with this process.
And Shawn, as I thought about this, I think the other big aha when you look at this, you need to then look at and say, what are the biggest risks that I have in my business? Because there might be things that you look at where you can manage, but other things you wouldn't dare to touch.
Yes. Yeah.
That in the fact that you need to protect that, you need to optimize that in order to stay competitive and stay in business. So then you need to lean into other areas. So I think those two things might be a really good thing to balance with one another.
Yes. Excellent point. Excellent point.
I knew there was a way. See, we get along. You compliment me all the time, Shawn.
Well, it's easy to agree with you when you're right. And you tell me you're always right, so there you go.
So what do you tell those people who find that inventory is tying up a lot of their cash? They've looked and done the calculations and said, my inventory turns are just far too slower than they need to be.
Right, and that is the first step. You need to understand how long does my inventory, sit on the shelf, and that's going to involve the simple ratio, or you can get into data analytics where you look at, what moves quickly, what doesn't. If you've got slow-moving inventory, what do you do? Well, do you really need to carry that? Or can you go to a just-in-time inventory system, which is good across the board, but if you've got something that's really slow-moving, chances are that it's not going to be a critical element for your customer, and so you can get rid of that and do a program with the supplier. I know that my son was went to the University of Auburn University, and in going there through Georgia, there's a couple of big auto plants, but clustered around all those plants are suppliers. So they just drive across the street. That's that just-in-time concept. And as a small business, it's not that people are going to flock around you, but if you at least start thinking in the way of how can I increase or decrease the time it takes me to get the inventory, which allows me to decrease the amount of inventory I have. So one aspect is say, how much money do I have to put in my inventory? The other is how often does it turn over? So move slow inventory out, and there are all kinds of working capital providers that will advance you funds against your inventory, inventory financing. The simplest example of that would be floor planning from a manufacturer, if you were a dealer, for instance. But look at these various ways to extract cash from your devourers of cash, in essence. And so like the inventory financing, just in time, analyze your inventory, see what you do need, what you don't, what you can get rid of, and minimize the amount of the inventory, and then increase the turn of your inventory.
Shawn, you mentioned something that I just really love, the concept that you can look at what larger businesses, larger industries, let's take the automotive industry where a large automotive plant has suppliers who surround them. But you can take those larger business concepts and apply it to your small business if you're just really innovative enough and thinking about how can you be as agile as you can be to minimize that time on your floor. I really just love that concept of not letting your size
limit you.
Limit you. I think that's a great lesson.
Absolutely.
And I know you mentioned, yes, I was actually fifth generation in our family business. It was a distribution business, and everything was about the inventory on our floor. I remember our salespeople used to say to me, Samantha, I can't sell if it's not on the truck. And it's so easy to convince yourself that that slow-moving piece of inventory is really just a sunk cost. But in reality, it's an opportunity cost. You know, your first loss on the slow-moving inventory is actually your best loss. So anything that you can think to do of getting that off your floor, discounting it, getting it to different, secondary markets, whatever they might be, is really important for the overall health of your business, because you can use that space for other faster, more profitable inventory.
Yeah, great insights. Great insights. Yeah, things we're telling you here are not, they're not theoretical. No, they're proven. They're the things that we use in our business or have used in our businesses every day.
Absolutely. And I think one of the things that we used to also explore a lot were different consignment programs, especially on getting inventory from overseas. You think about the time it takes to get there and the amount you have to order if you're ordering in containers. Consignment programs can help you in that process. And obviously, that's all about whether you can predict a steady volume. As your volumes change, those programs can be difficult to manage, for sure.
Yep.
So for some, it's just their overall payables that tie up cash, and they're really juggling who to pay when. How do you? What would your advice be for a small business in that situation?
Well, the standard wisdom is that you pay if you've been offered terms net 210, you have these great terms for paying early, that you do that because it provides a nice return. That whole concept presupposes that you have the cash to actually pay it. So it gets back to, well, if you got a lot of cash, then you should pay early. If you don't, then you want to look at finding ways to prioritize, change your the invoicing times when you receive invoices from your suppliers, if that's possible. I know that we get requests to do that once in a while, just because of the cycle. But building the flexibility to be able to pay when you need to pay. An example of this is that there's all these online alternatives, and there was a point when I was really struggling to manage cash. If it's online, it comes out automatically. I wanted to be able to stretch where I needed, and suppliers are not going to be happy about you stretching their payments but sometimes you need to, and you need to work with a lot of different suppliers with different terms, and you need to understand who's going to shut the lights off and who's not, and that's the key to this. Like say, prioritizers, suppliers, see if can we arrange to pay you 45 days instead of 30. If you're a customer, they're going to be willing to at least look at that. And then there's some real interesting payables programs out where you can engage a partner that will pay your bills on a timely basis and take advantage of that discount, for instance, which will help pay for the program. Or you can use them and they will extend you terms beyond what your supplier is asking of you. So there's some real opportunities there with what we call payables financing. We always hear about inventory and receivables, but on the flip side, if you can better manage your outflow and put off your outflow as long as possible, within reason, then you've gained another leg up in your cash flow cycle.
Absolutely. I know Pitney Bowes, we have started offering that to our clients, some forms of that, given our expertise in shipping, helping them consolidate those shipping invoices for just one bill, one set of terms, and really helping you hold on to your cash a little bit longer.
Right. I mean, in many cases, we've been able to, depending on the term, to double the length of time that they have to make payment.
Right.
So that's been very helpful to our customers.
Now, I have to say, in 2000, there were a lot of lessons I learned about this in 2008. And first and foremost is you don't know until you ask how much leverage you have as a customer. And talking to suppliers and changing your terms and getting different arrangements set up. So it's certainly really critical. And I love that you talk about prioritizing that suppliers. It sort of ties that bow back to where we talked to in the beginning of understanding your risks. And there are different ways to think about it. If that supplier is really critical to business, you want to be very careful. I think another way to look at it also is how much of your supplier's business are you. That may tell you how much leverage you may have in that conversation. That's a tricky needle to thread for sure. You want to be really careful with those very important suppliers, but you do have this sort of mutual need for one another, for sure.
Exactly. Yeah, and although this is the flip side, if you're extending credit, put your receivables hat on and apply it to your payables. I mean, are you going to throw a customer out the window because they're 10 days late? Maybe not. But view your payable patterns in your experience in receiving payments from your customers, and recognize these things that Sam has pointed out.
Right. So going to the cash, I mean, sales, I think you pointed out even initially, sales are great, but that doesn't always mean immediate cash flow.
That's right. And that's why this, when I described the cash flow tool, I said, you will sell some things for cash, but others you sell on account or some sort of open receivables financing. And that's not, your sales do not represent your cash. So it's very critical that you break out when the cash actually comes in. And the tool I'm describing, it's not difficult. And I would suggest that go to a couple of bank websites. Many of them have cash forecasting tools on their websites. They just throw it out there for you. Sam mentioned think like a big. Don't be constrained by the fact you're a little company. The larger companies, many of them have programs that they will help you understand how to manage your business, at least with them. And so they share resources. I guess that's my point here, is look for shared resources that can help you get some out of the box tools and techniques. You don't have to think all of this up yourself. So accelerate receivables. Sam, how are we going to do that?
Well, I like how you one of your first points here is early, active, and consistent collections. I think a lot of people think collections is about finding out when something's due in 30 days, following up at 40 or 45 days. And I think what you and I mean by early and active is understanding the behavior of your clients and following up for those who are traditionally late, even before due dates, but being on top of it on day one and yes. Beyond. And it really is you got to be the squeaky wheel for sure.
Yeah, absolutely. And my portfolio manager is for our our loan portfolio has instituted a process where we follow up 10 days after the invoice is sent. It's not past due, and we're not hounding the customer. It's just, did you get your invoice? Very simple. And that puts you top of mind. That's, are you the squeaky wheel? Well, think again, now you're in receivables, think of the payables side. Who do you pay first? Probably the one that's calling you the most about getting paid. So don't wait. Don't wait until it becomes past due, because it's a problem at that point. Be proactive in establishing expectations, in your policies on when it should be paid, when it should be, late fees. Okay, can you waive a late fee? Absolutely. But if you waive a late fee every month because you're worried about your customer leaving you, then you've lost the leverage of the late fee. And you have to, most customers are not going to leave you because of a late fee, because that's standard business practice. You're not asking anything outrageous or horribly wrong in enforcing a late fee policy.
And I love this concept of 10 days before. To me, you really just made that a relationship call versus a nasty collections call. And what a great way to start off that relationship. They expect to hear from you. We're about maintaining the communication, and so we're going to follow up with you to ensure you've got your invoice. I think that's really just really changing the game there.
Exactly.
How you talk to your customers. You don't just hear from us when you're late.
Yeah. So,
so your last point here on accounts receivable financing, Shawn, it's funny. I think a lot of small businesses might think that this is sort of evil and not want to give away any of their sales. Tell me about this, of how this can be beneficial and how to think about this differently.
Yeah, and absolutely, it's something that you think about. Well, why should I sell my receivables? And basically, think of it as it's cash flow sitting on your balance sheet that you don't have access to. And so if you can sell your receivables, we call it factoring most of the time. Yes, it comes at a cost, as every financial transaction does. You have to measure that cost and say, okay, if it costs me 3%, can I get that money faster and put it back into my cash cycle and get a return of 20% out on the back end? It's a very simple decision when you will put it in that light. So you can extract the cash from your balance sheet in the form of receivables by factoring. If you're doing a lot of credit card sales, there are companies that will offer what we refer to as merchant advances, where they will actually pay you in advance for sales that are going to occur in the future. And that takes a lot of, you've got to have the analytics and the proof behind, but that's a way that you can accelerate the cash flow back into the cycle. I can't emphasize enough that the more you can put into the cycle and the faster you can push a dollar through the cycle, the more profitable you're going to be. Because every dollar that you put in better come out with a profit on the other end, or you shouldn't even be in business unless you're doing it just because you're bored.
Right. I really like the concept that it's about fueling your growth and profits. And so what is the cost you're willing to pay? Is it a few basis points over the course of the year, or whatever it might be? So that's a really great way of thinking about it. And I think one of the players we do know who does it, for example, I think American Express, they do offer merchant advances against the receivables that you collect as being part of a credit card customer. So that's really different ways, and always be thinking out those alternatives of how you can think about things differently, for sure.
Yes, yeah, and that's, like I said at the beginning, we're just trying to give you a playbook that you can, give you alternatives to turn to when a certain situation arises.
Right. So let's talk. I really like this concept of how do you think out of the box and say, I'm just going to generate cash in a new way. Talk to me about some of the ideas that you had here.
Well, age old is, you just, you take out a second mortgage on your house, okay? You have to balance that with, your business's ability to, I'm not suggesting you take that on your house and put it into your business, although I know many of you do. But, if you can refinance, extend terms without getting too much leverage or too much of a debt load, that's a way to create some cash. Yes, it has an interest cost, but again, put it into the cycle, bring it out on the other end at a profit. So that's one way of looking at it. Sale leasebacks are a very popular way to monetize assets that are sitting on your books, and they're not necessarily idle because your machine tool is cutting parts and doing all of those things that you expect it to do, but its value is locked up on your balance sheet. So think of it as having some inherent value in addition to the value it creates through the production process. If you can take that asset, that machine tool, and sell it, and then lease it back, you still get the value of the production capabilities, but you've pulled cash out of that asset. So that's the benefit of a sale leaseback. It works particularly well with assets that retain value. Some of the big printing presses, or real estate is the one that comes to mind most of all. If you've got the warehouse sitting there or the property, and you can monetize that embedded market value, you can then push that through your cycle. So that's those would be ways to look at it. And we see just we're becoming a kind of a throwaway society. People don't want to own things. They just want to use them. And apply that to your business also. If you can outsource, or if you can shift your fixed cost structure to a variable cost structure. For instance, we're all familiar with software as a service. Do I want to buy something and hold it on my balance sheet? I just want to pay like per piece for every time I create a product. Your click contracts, copy per copy. You don't buy a big copier. You just pay based on the number of copies that you are made. And we see that all through everything. There's electricity as a service. There's software as a service. I've seen manufacturing as a service. There's all kinds of things that you can do to eliminate those elements on your balance sheet that capture cash and somehow release that cash into your operating cycle.
I think this harkens back to where we said before, this is really what people might typically think a big company concept, but that can don't be deterred by your size. It can be applied to help you really think about what's your core competency, which you're adding in the process, and what can easily be outsourced and on a usage-based level. And I think some people might think it would be limiting, but I think it actually works to help you be more agile and nimble with different market changes that happen around you.
Yes. Yep. Yeah, and there's all kinds of opportunities. I mean, Sam and I were talking. An example I gave her that I thought was quite clever was the producing plastic parts for in the automotive aftermarket, where normally I would buy an extruder or something. Now it's to the point where I would buy a 3D printing machine. But oftentimes the manufacturer will offer you a service where all you're doing is paying for the part that's produced, and that will, there's some minimums of, for powders and resins and things like that. but you no longer have to worry about maintaining the machine. It's just, I need 10 parts. They produce them for you as a service, you pay, and off you go.
Great, love those concepts. So last, we talked about you really should be looking at your overall financing structure. Let's talk a little bit about that.
Right. I mean, you know, we can look at long-term, short-term. That gets into, you know, interest rate movements and management. But I think the real key point for this discussion is just make certain that you have consistent availability and have it diverse. You know, as a bank, you know, we have lender limits. We can only lend so much for a individual customer. We can only lend so much into a region. We can only lend so much into an industry. And if you happen to be in one of those concentrations and your bank says, I'm sorry, you know, we can't take any more of your business, that was nothing to do with you. It's an external. Whereas if you have 2 or 3 options for, you know, working capital, term loans, equipment leasing, revolvers, then you insulate yourself against that. Whereas as a bank, I manage my exposure to different customers and industries. You can do the same thing with your funding sources. Just make certain that you have a good choice. It's nice to always go, you know, to have a primary bank because you want that relationship, but make certain you've got others in your back pocket, and work them all the time. Don't get comfortable with the relationship. Always be looking to renegotiate if circumstances change, because they will be doing the same thing to you. And then look at other alternatives. You know, there's fintech where you just you can go online and get a loan, or government-backed programs, whether it's small or large. You know, Sam and I worked on the Main Street program, for instance, and we have SBA. But Sam, did you want to address any of these?
Well, I'd say one thing I would say is back to your people of this loyalty to a relationship with a primary bank. And I've heard that so many times. And I actually think you make a better client, a better partner, if you are also diversifying your relationships. Banks like to know that you've also got other sources to help repay those loans. So it's really not being disloyal to that relationship. If anything, you're keeping it honest. To your point, you're working it all the time to make sure you're getting the most competitive information, and you're ensuring whatever may happen. That bank, no matter what a relationship you have, to your point, may be forced to back away at some point. You want to make sure you have those options. But I do think you talked about government-backed options, which today, you know, even more important, the range of things that are becoming more and more available due to the CARES Act. I know a lot of people took advantage of PPP, which was a great program. The government acted incredibly fast. I've never seen the government act so fast to institute a new program. While not perfect, a program that allowed small businesses to get backing for mostly payroll expenses, with the option of it being forgivable. I think the new program we've often talked about is the Main Street Lending Program for small to middle market companies, which itself has its own restrictions as well. But also looking at your state could offer some programs. I do know Connecticut built out a program. The Department of Economic and Community Development had a program for small businesses as well. In times like these, I would seek out all those options that you can, for sure. As well as your non-traditional sources. There are several new players emerging, fintechs, non-bank entities that can provide some options for you.
Exactly.
So in sum, I think what we're saying, Shawn, here is, you know, there isn't any one answer There isn't any bulletproof answer that can ensure you liquidity, except to really understand your business, back it by facts, and make sure you're always evaluating all the different angles you can do to optimize cash in the short term as well as the long term. Making sure you have access to credit, whatever may happen.
Perfect wrap up.
So do we have any questions from anyone?
Not so far.
Okay.
Well, that can be good or bad. One, we just done one heck of a job of explaining, or just numbed people to sleep. I don't know, but
Well, let's talk about what many people don't talk about probably that often. The Main Street Lending Program. That's a potential option for someone. They give out loans for 5 years. There are no payments for the first 2 years against the principal. Interest isn't paid until the second year. There is a real potential there, especially if you're finding right now you're in the midst of renegotiating loans. This might be your better option at this point. But there are also some restrictions to this that you need to make sure you adhere to, and be really careful that you investigate all of those rules to understand, to make sure this is the right fit for your business.
Yeah. And I mean, I think that the current rate is right around 3%. And these are available in amounts as low as 100,000. So again, it's not the same as PPP, but it's definitely targeted to stimulating growth and helping businesses get through a tough time right now.
Well, I think we're closing up just a little early, unless any other thoughts you had, Shawn, wanted to share?
No. It's been a pleasure as always, Sam, working with you. Hopefully we've imparted some value at some level.
And please, as I mentioned in the beginning, we're very interested in small and medium-sized businesses. They've been at the heart of Pitney Bowes since the beginning. And as we begin to expand our financial services capability, we're really looking at reinvesting in that client base and helping you grow. So think of us. We are backed by the Pitney Bowes Bank, FDIC, member of FDIC. If there are needs that you're thinking about in this time, we're here to support. Please reach out to us. So thank you very much for the time today.
All right, thank you, Shawn and Samantha. And every attendee on, please be sure to check out our event sponsors, including Pitney Bowes, by clicking on the sponsors tab on our event site at betterbusinesssummit.com. You also still have time to sign up for other breakouts, including our keynote speaker tomorrow, Larry Janeski, at 10:30 a.m. See you then, and thank you everybody for a great second day of our Business Summit.
Thank you.
Thank you.